Ready to test your skills on some must-know finance and closing questions you'll likely face on the real estate exam? In this video, we're covering 30 essential questions, from loans and closing costs to taxes and escrow. And don't miss what's happening in the bottom corner. It could supercharge your exam prep. We'll tell you more about that in a minute. Let's dive in.
Real estate finance. Types of loans and mortgages. What is a fixed-rate mortgage? Is it A, a mortgage with a fixed interest rate for the loan term? B, a mortgage with an interest rate that fluctuates monthly? C, a loan with no interest rate? Or D, a mortgage that can be refinanced anytime without fees? The answer is A, a mortgage with a fixed interest rate for the loan term. Fixed-rate mortgages have a consistent interest rate throughout the term, offering predictable monthly payments. This stability makes them popular among long-term homebuyers. Source: National Mortgage Licensing System. Which of the following best describes an adjustable rate mortgage? Is it A, a mortgage with consistent interest rates? B, a short-term loan with no interest charges? C, a mortgage with interest rates that adjust periodically based on an index? Or D, a loan that can never be refinanced? The answer is C, a mortgage with interest rates that adjust periodically based on an index. Adjustable rate mortgages have interest rates that vary based on a financial index. This can lead to changes in monthly payments, often starting with a lower initial rate. Source: Federal Reserve's Consumer Information.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsey.ai for immediate help and a free study session with Birdsey, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
What is a major benefit of a VA loan? Is it A, it requires a large down payment? B, it offers reduced closing costs and no private mortgage insurance? C, it is only available for investment properties? Or D, it is exclusive to first-time homebuyers? The answer is B, it offers reduced closing costs and no private mortgage insurance. VA loans, backed by the Department of Veterans Affairs, benefit eligible veterans by offering reduced costs and no requirement for PMI, easing financial barriers to homeownership. Source: U.S. Department of Veterans Affairs. Which type of loan allows for an interest-only payment option? Is it A, interest-only mortgage? B, conventional fixed-rate mortgage? C, government-insured mortgage? Or D, graduated payment mortgage? The answer is A, interest-only mortgage. Interest-only mortgages allow payments solely on interest for a preset period, reducing initial costs but without principal reduction during that time. Source: Consumer Financial Protection Bureau. What describes a balloon mortgage? Is it A, it requires large upfront payments followed by smaller ones? B, it offers a graduated payment schedule that increases periodically? C, it includes a large final payment to pay off the debt? Or D, the interest rate adjusts frequently throughout the loan term? The answer is C, it includes a large final payment to pay off the debt. Balloon mortgages feature regular payments during the loan term, similar to interest-only loans, with the balance due at the end in a single lump sum payment. In which scenario is a jumbo loan most likely required? Is it A, purchasing a home with a high market value exceeding conforming limits? B, buying a modest starter home within standard market limits? C, refinancing a small suburban home to reduce interest rates? Or D, acquiring a rural property with government-backed financing? The answer is A, purchasing a home with a high market value exceeding conforming limits. Jumbo loans are used for home financing when the purchase price is above the conforming loan limits set by the Federal Housing Finance Agency, typically needed in high-cost areas.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
Loan qualification and application process. Which of the following is not considered when determining a borrower's debt-to-income ratio? Is it A, monthly rent payments, B, student loan payments, C, car loan payments, or D, child support payments? The answer is A, monthly rent payments. Only applicable monthly debt payments and obligations, such as loans, credit card payments, and alimonies, are considered in the DTI ratio. What does a lender primarily assess when conducting an underwriter review? Is it A, real estate trends, B, property location, C, market interest rates, or D, borrower's credit score? The answer is D, borrower's credit score. Underwriters focus on the borrower's ability to repay the loan, which is significantly influenced by their credit score, income, and DTI ratio. Which factor directly affects the interest rate a borrower pays on a mortgage? Is it A, neighborhood facilities, B, property size, C, borrower's credit score, or D, time of year? The answer is C, borrower's credit score. Lenders use the borrower's credit score to assess risk. A lower score typically results in a higher interest rate due to perceived risk. Which document is typically required during the mortgage loan application process to verify employment history? Is it A, credit report, B, W-2 forms, C, bank statements, or D, property title? The answer is B, W-2 forms. Lenders often require W-2 forms as proof of employment and income. This helps them assess the borrower's capacity to repay the loan. Why is a credit score important during the mortgage loan qualification process? Is it A, it determines property value, B, it verifies employment, C, it estimates property taxes, or D, it affects loan approval and interest rates? The answer is D, it affects loan approval and interest rates. Credit scores reflect credit-related behaviors and influence lenders' decisions on loan approvals and the setting of interest rates. Government programs. What minimum down payment is required for an FHA loan? Is it A, 10%, B, 5%, C, 3.5%, or D, 15%? The answer is C, 3.5%. FHA loans require a minimum down payment of 3.5% for borrowers with a credit score of 580 or higher. This makes homeownership more accessible for those with lower credit scores. Which of the following is a feature of a VA loan? Is it A, no down payment required, B, strict income limits, C, only for new home purchases, or D, available to all U.S. citizens? The answer is A, no down payment required. VA loans are a benefit provided to veterans, allowing them to purchase a home with no down payment, making it easier for them to achieve home ownership. What is a key eligibility requirement for a USDA rural development loan? Is it A, property location in a rural area, B, maximum loan amount of $300,000, C, 20% down payment, or D, minimum income of $50,000? The answer is A, property location in a rural area. A USDA rural development loan requires the property to be located in a designated rural area to qualify, allowing for no down payment for eligible buyers. Which program requires private mortgage insurance if a buyer puts less than 20% down? Is it A, Federal Housing Administration, FHA, B, U.S. Department of Veterans Affairs, C, U.S. Department of Agriculture, USDA, or D, Conventional. The answer is D, conventional. Private mortgage insurance protects lenders on conventional loans when the buyer puts less than 20% down to lessen lender risk in case of default by the borrower.
Stuck on a question? Just think of the Birdsey link in the description as your friendly neighborhood superhero swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Mortgage markets and regulatory bodies. Which federal entity is primarily responsible for overseeing the mortgage market and ensuring the safety and soundness of the financial system? Is it A, Federal Reserve Board, B, Consumer Financial Protection Bureau, C, Federal Housing Finance Agency, or D, Federal Deposit Insurance Corporation? The answer is C, Federal Housing Finance Agency. The FHFA oversees Fannie Mae and Freddie Mac, ensuring the efficient functioning and safety of the mortgage market. What is the primary purpose of the Real Estate Settlement Procedures Act? Is it A, to regulate interest rates on mortgages, B, to require disclosure of closing costs and eliminate kickbacks, C, to determine mortgage eligibility criteria, or D, to set maximum loan amounts? The answer is B, to require disclosure of closing costs and eliminate kickbacks. RESPA ensures that homebuyers receive disclosures about the real costs of the settlement process and prohibits kickbacks in real estate transactions. Which agency enforces regulations related to consumer credit protection in the mortgage industry? Is it A, Securities and Exchange Commission, B, Federal Trade Commission, C, Consumer Financial Protection Bureau, or D, Office of the Comptroller of the Currency? The answer is C, Consumer Financial Protection Bureau. The CFPB oversees and enforces federal regulations regarding mortgage credit education, ensuring transparency and fairness for consumers. Underwriting. What is the primary purpose of underwriting in real estate finance? Is it A, to assess the property's market value, B, to determine the risk of the loan application, C, to forecast market trends, or D, to secure insurance for the loan? The answer is B, to determine the risk of the loan application. Underwriting involves assessing the loan applicant's ability to repay the loan and the risks associated with the loan. It is a critical step to protect the lender. Which factor is typically analyzed during the loan underwriting process? Is it A, credit history of the borrower, B, weather trends in the area, C, annual property festival schedules, or D, architectural style of the property? The answer is A, credit history of the borrower. Underwriters evaluate the borrower's credit history to assess the likelihood of loan repayment. A strong credit history suggests lower risk for the lender. How does a debt-to-income ratio impact underwriting decisions? Is it A, it helps to set interest rates, B, it indicates the borrower's financial health, C, it evaluates the property's location risk, or D, it predicts future real estate trends? The answer is B, it indicates the borrower's financial health. The debt-to-income ratio helps underwriters determine a borrower's ability to manage monthly payments and repay debts, thus indicating financial stability. During the underwriting process, what is a key indicator of the applicant's ability to repay the loan? Is it A, loan-to-value ratio, B, credit score, C, appraised property value, or D, property location? The answer is B, credit score. Credit scores are critical as they summarize credit behavior, helping underwriters determine the likelihood of timely loan repayment based on past performance and lending criteria. Loan closing and costs. Which document is most critical for detailing all costs associated with closing a real estate transaction? Is it A, deed, B, closing disclosure, C, promissory note, or D, purchase agreement? The answer is B, closing disclosure. The closing disclosure is essential as it itemizes all costs involved in the transaction, providing transparency to both parties about fees and charges in compliance with federal regulations. What is typically included in a buyer's closing costs? Is it A, loan origination fees only, B, down payment, C, title insurance, loan origination fees, and appraisal fees, or D, property tax for the next year? The answer is C, title insurance, loan origination fees, and appraisal fees. Buyers' closing costs often include various fees such as title insurance, loan origination, and appraisal fees, alongside other potential charges like inspection fees and prepaid interest. Why is a title search conducted during the real estate closing process? Is it A, to appraise the property's value, B, to establish property boundaries, C, to uncover any liens or encumbrances on the property, or D, to finalize the mortgage rate? The answer is C, to uncover any liens or encumbrances on the property. A title search ensures that the property is free of encumbrances, such as liens or claims that could affect the new owner's title and right to use the property, protecting the buyer and lender. How many days in advance must lenders provide the closing disclosure to borrowers prior to closing? Is it A, 3 days, B, 1 week, C, 10 days, or D, on the day of closing? The answer is A, 3 days. The closing disclosure rule under the TRID mandates a 3 business day period before closing, ensuring borrowers can review and understand the final terms and costs of the mortgage.
Don't forget to comment below with your tips, challenges, and thoughts on exam preparation. Your experiences can make a big difference for others.
Taxation and assessment. What is the primary purpose of property tax assessments? Is it A, to determine a property's market value for sale, B, to calculate the mortgage payment for property owners, C, to fund local amenities and services through taxation, or D, to verify compliance with zoning laws? The answer is C, to fund local amenities and services through taxation. Property tax assessments are conducted to determine a property's taxable value, ensuring local governments receive revenue to fund schools, infrastructure, and essential services. Which factor can influence a property's assessed value for taxation? Is it A, the property's rental income, B, the property's location, C, the owner's credit score, or D, the color of the property's exterior? The answer is B, the property's location. Property location affects its assessed value, as proximity to amenities and services can increase demand and thus higher tax assessments. How often are property tax assessments typically conducted? Is it A, every 5 years, B, annually or biannually, C, once at the time of purchase, or D, every decade? The answer is B, annually or biannually. Property tax assessments are typically conducted annually or biannually to ensure tax levels reflect the property's current market value. How is the assessed value of a property typically used in real estate transactions? Is it A, to determine the property's sale price, B, to establish the property's insurance premium, C, to calculate annual property taxes, or D, to set the amount of a loan secured by the property? The answer is C, to calculate annual property taxes. Assessed values are calculated by local assessors to determine property tax amounts, not for setting sale prices or insurance.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit birdsey.ai for complimentary study sessions with Birdsey, your AI-powered study partner.